The warehouse reports came in quietly, as they always do. Every Friday afternoon, Shanghai updates its silver inventory numbers based on publicly released exchange data. Most traders glance at the figures and move on. But last week's data contained something that should have stopped every analyst cold. For the fifth consecutive week, Shanghai silver vaults increased by another 20 tons. The total now sits at 39.5 million ounces. That represents a 343-ton surge over just 5 weeks. This discussion is for educational and analytical purposes only and does not constitute financial advice. Numbers like these don't emerge from normal market behavior under typical historical conditions. They signal something deeper. While Western markets focused on price volatility and technical patterns, the physical reality in Shanghai told a completely different story. The metal wasn't just moving, it was accumulating at rates that appear to suggest fundamental shifts in how silver moves through the global system. The accumulation coincided with something else. Chinese silver imports hit a 3-year high of 390 tons last December. By June and July, those imports broke through the 400-ton level. A year earlier, import levels averaged half that amount, hovering around 200 tons monthly. The progression wasn't gradual, it accelerated. But here's what makes the Shanghai signal particularly difficult to dismiss. While inventories built in Chinese vaults, warehouse stocks elsewhere began disappearing. London lease rates spiked to 8 and 9%. Silver inventory at the Shanghai Futures Exchange once fell below 446 tons, hitting the lowest level since 2016. In October alone, that inventory decreased by more than 300 tons. The pattern suggests something may have crossed a threshold. The metal began moving not just between markets, but between systems entirely. Western financial centers experienced inventory depletion, while Eastern physical hubs accumulated material at unprecedented rates. This wasn't arbitrage in the conventional sense. This was restructuring. What changed? The answer lies not in financial markets, but in the physics of how modern technology consumes silver. A technological shift has been building for years, hidden beneath conventional market analysis. The shift involves how silver functions in systems that define 21st century infrastructure, and the implications have only recently begun to surface in physical demand patterns. The breakthrough centers on photovoltaic technology and the irreplaceable role silver plays in converting sunlight to electricity. This isn't about incremental improvements in solar panels. This involves a fundamental change in how efficiently solar cells capture and transport energy, and that change has created what amounts to an entirely new category of silver consumption. Modern solar panels require approximately 20 grams of silver in conductive paste applied to silicon wafers on average, depending on cell design and manufacturing specifications. The silver creates electrical pathways that capture and transport energy generated by photovoltaic cells. For decades, engineers attempted to substitute copper or aluminum for these applications. Those attempts consistently failed because alternative metals cannot match silver's conductivity in the thin layers required for efficient panel design. The physics is unforgiving. Silver possesses the highest electrical and thermal conductivity of any element. In photovoltaic applications, where microscopic layers must transport maximum electrical current with minimal resistance, silver remains technically irreplaceable. Any substitution results in measurable efficiency losses that can make solar installations economically unviable. But the technological shift goes deeper than simple conductivity requirements. The solar industry has been transitioning to newer, more efficient cell technologies that actually increase silver consumption per unit. As production shifts from traditional P-type cells to more advanced N-type configurations, silver paste consumption has increased by nearly 80% per panel, according to published industry manufacturing data. For heterojunction technology cells, consumption has almost doubled. This transition is occurring precisely as global solar capacity experiences exponential growth. China increased its solar capacity by 45% in 2024 alone, according to official energy deployment statistics. The country now dominates solar manufacturing and installation, accounting for nearly 90% of solar-related silver consumption during peak production periods. China's renewable energy policies and manufacturing capacity make it the primary driver of photovoltaic silver demand worldwide. The math becomes stark when these trends converge. Solar panels absorbed 197 million ounces of silver in 2024, representing nearly 1/5 of total global demand. This figure has more than tripled since 2015 as renewable energy adoption accelerated. Solar-specific demand alone accounted for 17% of total silver demand in 2024, compared to 5.6% in 2015. The International Energy Agency projects renewable energy demand for silver will reach 510 million ounces annually by 2030. McKinsey estimates total silver demand could reach 1.6 billion ounces by 2030, while supply may only reach 1.1 billion ounces. The gap represents not just a shortage, but a structurally constrained supply-demand imbalance under current production assumptions. These projections assume technology remains static, but the technological shift continues accelerating. Advanced solar technologies require progressively more silver per unit of capacity. As efficiency requirements increase and panels become more sophisticated, silver consumption per installation grows rather than shrinks. The Jevons paradox applies directly here. As technology becomes more efficient at using silver, total consumption increases because efficiency enables greater deployment. The demand math reveals why Shanghai's accumulation pattern matters. If current technological trends continue as projected, solar applications alone could consume more silver annually than total global mine production within 5 years. That calculation excludes all other industrial applications, electronics manufacturing, medical devices, and traditional uses that have driven silver demand for decades. Conservative scenarios still project annual deficits exceeding 200 million ounces through 2027. Moderate adoption rates suggest deficits could reach 300 million ounces annually. Aggressive renewable energy deployment scenarios indicate deficits approaching 500 million ounces per year by the end of this decade. These aren't speculative projections in the colloquial sense. They represent mathematical outcomes based on announced government policies, committed manufacturing capacity, and technological transitions already underway in industrial facilities worldwide. The demand isn't theoretical, it's contractual. Global silver mine production has remained essentially flat for over a decade, fluctuating between 813 and 830 million ounces annually. Production faces constraints that cannot be resolved quickly within existing mining development timelines. Declining ore grades mean miners must process 4 times more rock today to extract the same amount of silver compared to 20 years ago. Roughly 72% of mined silver comes as a byproduct of copper, lead, and zinc operations rather than primary silver mines. This byproduct dependency creates a fundamental constraint. Silver supply responds slowly to price increases because extraction rates depend on demand for unrelated base metals. Mining companies cannot simply increase silver production in response to industrial demand. They must wait for copper or zinc markets to justify expanded operations. New mine development requires 10 to 15 years from discovery to production. Even if massive silver deposits were discovered today, they wouldn't contribute to supply until the late 2030s under standard permitting and development processes. But the technological demand shift is happening now. Solar manufacturing capacity is being built today for installations planned through 2028. The supply constraints extend beyond geology. Mexico produces 25% of global silver, but the government has stopped issuing new open-pit mining permits according to publicly stated regulatory policy. Peru faces constant labor disruptions and protests. Russia remains sanctioned from Western markets. The largest silver-producing regions face political and operational challenges precisely when industrial demand reaches critical levels. Recycling cannot bridge the gap under current technological and economic conditions. Silver recycling rates remain below 20%, compared to nearly 90% for gold. Silver gets dispersed in microscopic quantities across billions of electronic devices and industrial applications. The metal exists in concentrations too low to economically recover. Each smartphone contains roughly 1/10 of a gram of silver. Each laptop contains half a gram. Solar panels contain silver in thin films that become permanently embedded in silicon substrates. The silver consumed in modern applications effectively disappears from the recycling stream for extended periods of time. It returns to the earth in forms impossible to extract economically. Meanwhile, technological applications sequester silver for decades. Solar panels operate for 25 to 30 years before replacement. The silver installed in panels today won't return to markets until the 2050s. Historical precedent suggests how markets respond when new industrial applications collide with inelastic supply. During the 1970s, automotive catalytic converter adoption created sudden demand for platinum and palladium. Prices increased by multiples as industrial users competed for limited supply. The semiconductor boom of the 1990s triggered similar dynamics in rare earth elements and specialty metals. But those transitions involved smaller markets with more substitution possibilities and longer adjustment timelines. The renewable energy transition represents the largest industrial materials shift since the electrification of the early 20th century. And silver's unique properties make substitution extremely difficult across multiple critical applications simultaneously. The Shanghai accumulation pattern suggests institutional recognition of these constraints. While Western financial markets focused on price charts and sentiment indicators, Eastern industrial centers began securing physical supply ahead of projected shortfalls. The accumulation wasn't speculative. It was strategic based on long-term industrial planning considerations. Market pricing systems historically lag physical reality during structural transitions. Prices reflect current supply and demand, not future constraints. Financial instruments trade based on immediate liquidity conditions, not long-term material availability. This lag creates periods where paper prices diverge significantly from physical market conditions. The divergence becomes self-reinforcing. As physical material accumulates in strategic stockpiles, available supply for financial trading shrinks. Smaller amounts of metal support larger amounts of paper trading activity. Price volatility increases as modest changes in sentiment create disproportionate movements in thinly supplied markets. Current conditions suggest this dynamic may already be underway. COMEX registered silver inventories declined by over 70% from their 2020 peak, dropping from 346 million ounces to just 82 million ounces by late 2023. ETF holdings decreased by 118 million ounces during 2023 alone as institutional investors took physical delivery. These inventory drawdowns occurred while industrial demand reached record levels for 4 consecutive years. The combination of rising consumption and falling available inventory creates conditions where small demand increases trigger disproportionate price responses. Markets become more sensitive to incremental buying as freely traded supply diminishes. The psychological pressure emerges from contradictions between visible price signals and underlying physical realities. Traders accustomed to financial market patterns struggle to interpret commodity markets during structural transitions. Price movements that seem irrational from a financial perspective often reflect rational responses to physical constraints invisible in conventional analysis. Common skepticism focuses on 2 primary objections. First, that technological efficiency improvements will reduce silver consumption per unit over time. Historical data contradicts this assumption. As solar technology advances, efficiency gains have consistently been offset by increased deployment and higher silver content per unit. Advanced cell technologies require more silver, not less. Second, that high prices will stimulate increased mining production. This objection ignores the byproduct nature of most silver production and the decade-plus timelines required for new mine development. Silver cannot be mined on demand like other commodities. Supply responses require sustained high prices across multiple base metal markets simultaneously. The structural changes influencing silver demand and supply have already begun affecting real-world industrial decisions. Solar manufacturers have started securing long-term silver supply contracts at fixed prices to ensure manufacturing continuity. Electronics companies have begun designing silver inventory into their supply chain management systems. These decisions reflect recognition that silver availability, not just price, has become a critical business constraint. The Shanghai signal represents more than inventory accumulation. It suggests that industrial users and strategic buyers have recognized the mathematical impossibility of current consumption trends continuing under existing supply constraints as currently understood. Physical accumulation patterns indicate preparation for a market structure fundamentally different from historical norms. The mathematics of industrial transitions rarely announce themselves through headlines or press releases. They emerge slowly through data points that seem disconnected until viewed through the lens of material physics. Over the past 18 months, a pattern has been building across global commodity flows, manufacturing schedules, and energy infrastructure deployments that suggest something fundamental has shifted in how modern civilization consumes critical materials. The pattern becomes visible when examining the intersection of 3 seemingly unrelated developments. First, renewable energy installations have begun consuming raw materials at rates that exceed historical projections by significant margins. Second, the technological specifications for these installations have quietly evolved to require higher concentrations of specific elements per unit of capacity. Third, the supply chains for these elements have demonstrated increasing inability to expand production at rates matching demand growth. This discussion is for educational and analytical purposes only, and does not constitute financial advice. What makes this pattern significant is not the gradual nature of each individual trend, but the convergence point they collectively approach. Industrial economists recognize this convergence as a phased transition, where incremental changes in multiple variables combine to create discontinuous shifts in system behavior. The global material system appears to be crossing one such threshold, driven by the physics of energy conversion technologies that have moved from laboratory curiosities to industrial necessities within a single decade. The specific material at the center of this transition possesses properties that make it irreplaceable in applications that define 21st century infrastructure. Its atomic structure provides electrical and thermal conductivity characteristics unmatched by any other element. These properties have made it essential for technologies ranging from electronics miniaturization to renewable energy systems, yet global supply has remained essentially static for over a decade while demand applications have multiplied exponentially. The technological shift driving this material consumption involves photovoltaic energy conversion, but extends beyond simple solar panel manufacturing to encompass the entire infrastructure required for electrical grid modernization. Advanced energy storage systems, smart grid components, and electric vehicle charging networks All depend on technologies that consume this material in quantities that scale directly with installation capacity. The breakthrough that triggered widespread adoption centers on efficiency improvements in photovoltaic cells that simultaneously require higher concentrations of conductive materials per unit. As solar technology advanced from traditional crystalline silicon designs to more sophisticated configurations, the material requirements per panel increased rather than decreased. Tunnel oxide passivated contact cells require nearly 80% more conductive material than previous generations. Heterojunction technology cells consume almost double the material content of conventional designs. These efficiency improvements initially appeared to reduce material intensity per unit of energy production. However, the enhanced performance enabled solar installations in geographic regions and applications previously considered economically unviable. The expanded deployment possibilities more than offset the efficiency gains, creating a net increase in total material consumption even as technology improved. The physics underlying this trend reflects fundamental constraints in electrical conductor design. Silver possesses the highest electrical and thermal conductivity of any element, characteristics determined by its atomic electron configuration. In photovoltaic applications, where microscopic conductive pathways must transport maximum electrical current with minimal resistance losses, silver remains technically irreplaceable. Alternative materials consistently produce measurable efficiency degradations that compromise system economics. Engineering teams across multiple industries have invested decades attempting to develop silver substitutes or reduction strategies. These efforts have consistently encountered the same physical barriers. Copper exhibits roughly 94% of silver's conductivity, but requires thicker applications that interfere with optical properties in solar cells. Aluminum provides adequate conductivity for many applications, but forms oxide layers that degrade performance over time in high-efficiency systems. The industrial scaling timeline for this technological transition has compressed dramatically compared to historical precedent. Solar manufacturing capacity expanded by 45% globally during 2024 alone, with additional capacity scheduled for completion through 2027, representing another doubling of current production rates. Unlike previous industrial transitions that occurred over multiple decades, the renewable energy conversion is proceeding at unprecedented speed, driven by policy mandates and climate commitments. This acceleration has created temporal mismatches between technology adoption schedules and material supply development timelines. Solar manufacturing facilities operate on 18 to 24-month construction schedules. Mining operations require 10 to 15 years from discovery to production. The temporal gap between demand materialization and supply response has widened to the point where conventional market mechanisms cannot maintain equilibrium. Current demand mathematics reveal the structural nature of this imbalance. Photovoltaic applications consumed 197 million ounces of silver during 2024, representing nearly 20% of total global demand. This figure reflects a tripling of solar-specific consumption since 2015, with growth rates averaging 12.6% annually. If current technological specifications and deployment schedules continue, solar applications alone could require over 400 million ounces annually by 2030, under widely cited industry projections. Conservative adoption scenarios, based on announced government policies and committed manufacturing capacity, project silver demand reaching 1.4 billion ounces annually by 2030. Moderate scenarios, incorporating technological advancement rates observed over the past decade, suggest demand approaching 1.6 billion ounces. Aggressive scenarios, assuming accelerated renewable energy deployment to meet climate commitments, indicate potential demand exceeding 1.8 billion ounces annually in modeling outcomes published by multiple research institutions. These projections assume technology remains static, which historical precedent suggests is unlikely. Technological advancement in energy systems typically increases material intensity initially as performance improvements outweigh efficiency gains. The semiconductor industry experienced similar dynamics during its rapid expansion phases, where miniaturization increased rather than decreased total material consumption as applications multiplied faster than unit efficiency improved. The demand scenarios become particularly significant when compared to supply constraints that have persisted across multiple economic cycles. Global silver mine production has remained essentially flat for 15 years, fluctuating between 813 and 830.5 million ounces annually. Production levels face geological constraints that cannot be resolved through increased investment or technological advancement within realistic time horizons. Declining ore grades represent the primary geological barrier to expanded production. Silver mines averaged 15 ounces per ton of processed ore in 2005. Current operations average 4 ounces per ton, requiring 4 times more material extraction and processing to yield equivalent silver output. This grade decline reflects the depletion of high concentration deposits and the shift toward lower grade sources that require exponentially more energy and capital per unit of production. The recycling limitations become more severe when considering the dispersed nature of modern silver applications. Each smartphone contains approximately 1/10 of a gram of silver distributed across multiple microscopic components. Laptops contain roughly half a gram spread throughout circuit boards and connectors. Solar panels embed silver in thin films permanently bonded to silicon substrates during manufacturing processes that make separation economically impossible at prevailing metal prices. This dispersion means silver consumed in contemporary applications effectively disappears from potential recycling streams. Unlike gold, which concentrates in jewelry and coins that remain accessible for recovery, silver gets distributed in quantities too small to justify extraction costs. The metal returns to landfills in forms that require more energy to recover than the recovered silver provides economic value. Meanwhile, the operational lifespan of technologies consuming silver creates temporal delays between consumption and potential recovery that span decades. Solar installations operate for 25 to 30 years before replacement cycles begin. Electric vehicle components remain in service for 15 to 20 years. The silver installed in renewable energy infrastructure today will not become available for recycling until the 2040s and 2050s, long after current supply shortfalls require resolution. Historical precedent demonstrates how markets respond when new industrial applications encounter inelastic supply conditions. During the 1970s, automotive catalytic converter adoption created sudden platinum and palladium demand that exceeded existing supply capacity. Prices increased by multiples as industrial users competed for limited material availability. The semiconductor boom of the 1990s triggered similar dynamics in rare earth elements and specialty metals required for miniaturized electronics. However, those transitions involved smaller markets with greater substitution possibilities and longer adoption timelines that allowed supply responses to develop. The renewable energy transition represents the largest industrial materials shift since electrification began in the early 20th century. Silver's unique atomic properties make substitution extremely difficult across multiple critical applications simultaneously, while the compressed timeline for renewable energy deployment eliminates the gradual adjustment periods that characterized previous commodity transitions. The Shanghai accumulation pattern indicates institutional recognition of these constraints before they fully manifest in pricing systems. While Western financial markets focused on technical analysis and sentiment indicators, Eastern industrial centers began securing physical supply ahead of projected shortfalls. The accumulation represents strategic positioning rather than speculative activity, suggesting industrial users have internalized the mathematical implications of current consumption trajectories based on long-range planning assumptions. Market pricing systems historically lag physical reality during structural transitions because financial instruments reflect immediate liquidity conditions rather than long-term material availability. Prices respond to current supply and demand interactions, not future constraints that may take years to fully materialize. This temporal lag creates extended periods where paper market prices diverge significantly from underlying physical market conditions. The divergence becomes self-reinforcing as physical material accumulates in strategic stockpiles, reducing available supply for financial market trading. Smaller quantities of metal must support larger amounts of paper trading activity, increasing price sensitivity to modest changes in market sentiment. Volatility increases as incremental buying or selling creates disproportionate price movements in markets where freely traded supply has diminished substantially. Current inventory data suggests this dynamic has already commenced across multiple storage and trading venues according to publicly reported warehouse statistics. COMEX registered silver inventories declined by over 70% from their 2020 peak, falling from 346 million ounces to just 82 million ounces by late 2023. Global ETF holdings decreased by 118 million ounces during 2023 alone as institutional investors took physical delivery rather than maintaining financial exposure. These inventory drawdowns occurred simultaneously with industrial demand reaching consecutive record levels for 4 years. The combination of rising consumption and falling available inventory creates market conditions where small demand increases trigger disproportionate price responses. Markets become increasingly sensitive to incremental buying activity as the pool of freely traded supply contracts. The psychological pressure emerges from contradictions between visible price signals and underlying physical realities that remain largely invisible to conventional market analysis. Traders accustomed to financial market patterns struggle to interpret commodity markets during structural transitions, where price movements that appear irrational from a financial perspective often reflect rational responses to physical constraints that standard analytical frameworks cannot capture. Common skepticism regarding supply shortage scenarios focuses on 2 primary objections that merit examination. First, that technological efficiency improvements will reduce silver consumption per unit over time, eventually alleviating material constraints through innovation. Historical data contradicts this assumption across multiple technology categories. As solar cell technology has advanced over the past decade, efficiency gains have consistently been offset by increased deployment rates and higher silver content per unit in advanced cell designs. The Jevons paradox applies directly to this situation, where technological improvements that increase efficiency and material usage typically result in higher total consumption, as improved performance enables broader application deployment. More efficient solar panels become economically viable in geographic regions, and applications previously considered marginal, expanding total installation volumes faster than unit efficiency, reduces material intensity. Second, that elevated prices will stimulate increased mining production sufficient to meet rising demand. This objection overlooks the byproduct nature of most silver production and the decade-plus timelines required for new mine development. Roughly 72% of silver comes as a byproduct of copper, lead, and zinc operations, rather than primary silver mines. Silver supply cannot simply expand in response to industrial demand, because extraction rates depend on market conditions for unrelated base metals that operate on different supply and demand cycles. New mining projects require 10 to 15 years from initial discovery through environmental permitting, financing, construction, and production startup. Even if massive silver deposits were identified today, they would not contribute meaningful supply until the late 20s or early 30s. The technological demand shift creating current supply pressure is occurring now, with manufacturing capacity being constructed for installations scheduled through the remainder of this decade. The structural changes influencing silver supply and demand patterns have begun affecting real-world industrial and governmental decision-making processes. Solar manufacturers have initiated long-term silver supply contract negotiations at fixed prices to ensure manufacturing continuity. Electronics companies have begun incorporating silver inventory costs into supply chain management systems as a critical business constraint rather than a minor input cost. These operational changes reflect institutional recognition that silver availability, not merely price, has become a strategic business consideration. Government agencies responsible for renewable energy deployment have started evaluating material supply constraints as potential bottlenecks to policy implementation. The Department of Energy has commissioned studies examining critical material requirements for renewable energy infrastructure. The European Union has designated silver as a critical raw material requiring supply chain diversification strategies. These policy responses indicate official recognition that renewable energy goals may face material rather than technological or financial constraints. The Shanghai signal represents more than inventory accumulation or regional arbitrage opportunities. It suggests that industrial users and strategic buyers have recognized the mathematical impossibility of current consumption trends continuing under existing supply constraints as presently modeled. Physical accumulation patterns indicate preparation for a market structure fundamentally different from historical norms, where material availability rather than financial capacity determines industrial planning decisions. The transition appears irreversible because the technological systems driving silver consumption have moved beyond experimental phases into industrial deployment with committed capital investments and regulatory mandates. Solar manufacturing facilities represent billion-dollar investments that cannot easily pivot to alternative technologies. Renewable energy installations operate under 20 to 30-year power purchase agreements that lock in technology specifications. Electric grid modernization projects span decades and depend on specific material characteristics that silver uniquely provides. The numbers suggest this transition has already begun influencing industrial behavior, even while financial markets continue operating under assumptions that may no longer reflect physical reality. The mathematical relationship between renewable energy deployment schedules and silver supply capacity indicates that current market structures will likely require substantial adaptation to accommodate constraints that physics and geology impose on policy preferences and financial expectations. This discussion is for educational and analytical purposes only and does not constitute financial advice.